Ever wondered what a personal loan really is and how it works? You're not alone. In simple words, a personal loan is money you borrow from a bank or lender that you agree to pay back in fixed monthly payments, usually with interest. People use them for things like medical bills, home repairs, or even big purchases. But before you borrow, it's important to understand how they work. And that's exactly what we're breaking down today, in the simplest terms possible. Today we'll talk about personal loans explained in simple words. So before we start, make sure to hit the like button and subscribe to my channel. 1. What is a personal loan? A personal loan is a sum of money borrowed from a bank, credit union, or online lender that you agree to pay back over time, usually in fixed monthly installments. It is typically used for personal expenses like medical bills, home improvements, travel, education, or emergencies. Unlike a mortgage or auto loan, which are meant for specific purchases and are secured by an asset, like a house or car, personal loans are often unsecured. This means you don't need to offer anything as collateral. You simply borrow the money based on your creditworthiness and income. Once approved, the full loan amount is usually deposited directly into your bank account, and you repay it over a period ranging from 1 to 7 years, depending on the loan terms. 2. How do personal loans work? When you take out a personal loan, you receive the entire loan amount up front. From there, you begin repaying the loan in fixed monthly payments that cover both the principal, the amount you borrowed, and the interest, the lender's fee for letting you use their money. These payments are spread out over a predetermined period, called the loan term, and usually remain the same every month, which helps with budgeting. For example, if you borrow $10,000 at a 10% annual interest rate for 3 years, you'll repay around $322 every month for 36 months. At the end of the term, the loan is fully paid off. It's important to remember that the interest rate and length of the loan greatly impact how much you'll pay overall. 3. Secured vs. unsecured personal loans. There are two main types of personal loans, secured and unsecured. An unsecured personal loan doesn't require any collateral, meaning the lender takes a higher risk and relies mainly on your credit score and financial history to decide whether to approve you. These are the most common type of personal loan. In contrast, a secured personal loan requires you offer an asset, like a car, savings account, or other valuable item as collateral. If you fail to repay the loan, the lender can take ownership of that asset. Secured loans are considered less risky for the lender, so they often come with lower interest rates. However, they carry more risk for the borrower because you could lose your property if you default on the loan. 4. What can you use a personal loan for? Personal loans are flexible and can be used for nearly any legal personal expense. Common uses include consolidating high-interest credit card debt, paying for home repairs or renovations, covering unexpected medical bills, funding major life events like weddings or funerals, covering tuition or educational costs, or even financing a vacation. Many people also use personal loans to handle emergency expenses when they don't have enough savings. However, lenders may restrict certain uses, such as investing in stocks or starting a business. So it's always a good idea to ask about acceptable uses before taking the loan. Using the money wisely and for necessary expenses is key to getting the most value out of a personal loan. 5. Interest rates and fees. What you're really paying? When you borrow money through a personal loan, you're not just repaying the amount you borrowed. You're also paying interest, which is the lender's charge for giving you the loan. The interest rate is usually expressed as an annual percentage rate, APR, which includes the interest and any additional fees. APRs for personal loans can range widely, from as low as 5% for borrowers with excellent credit, up to 30% or more for those with poor credit. The rate you're offered depends on your credit score, income, and financial history. In addition to interest, some lenders charge origination fees, a one-time setup fee, late payment fees, or prepayment penalties if you pay off the loan early. Always read the terms and conditions carefully so you understand all the costs involved. 6. How credit score affects your loan approval and terms. Your credit score is one of the most important factors lenders consider when you apply for a personal loan. This 3-digit number, ranging from 300 to 850, reflects your credit history, how well you've handled borrowing and repaying money in the past. A higher credit score tells lenders you're a reliable borrower, which can help you qualify for larger loan amounts, lower interest rates, and better terms. Borrowers with poor credit may still get approved, but they'll likely pay higher interest, and may be offered shorter repayment terms to improve your chances of getting approved with favorable terms. It's a good idea to check your credit score before applying and take steps to improve it if needed, such as paying down debt, making on-time payments, and correcting any errors on your credit report. 7. Loan terms and monthly payments. The loan term is the length of time you have to repay your personal loan, and it usually ranges from 12 months to 84 months, 1 to 7 years. Shorter terms mean you'll pay less interest overall, but your monthly payments will be higher. Longer terms lower your monthly payments, but you'll end up paying more interest over time. For example, if you borrow $10,000 for 3 years at a 10% APR, you might pay around $322 per month. If you extend that to 5 years, your payment drops to around $212, but you'll pay more in total interest. It's important to choose a loan term that balances affordability with overall cost. Make sure your monthly payment comfortably fits within your budget so you can avoid missed payments and late fees. 8. Pros and cons of personal loans. Like any financial product, personal loans come with both advantages and disadvantages. On the plus side, personal loans offer flexibility, predictable payments, and usually lower interest rates than credit cards. They can be a smart way to manage debt or fund important expenses. Since many personal loans are unsecured, you don't need to risk losing your assets. However, the downsides include interest costs, fees, and the risk of falling into more debt if you don't manage the loan properly. If you have poor credit, you may be offered high interest rates or be denied altogether. Also, because personal loans are a form of debt, they can impact your credit score if you miss payments. Weighing the pros and cons carefully can help you decide if a personal loan is the right choice. 9. How to apply for a personal loan, step-by-step process. Applying for a personal loan is relatively straightforward, but it helps to be prepared. First, check your credit score so you know what kinds of rates to expect. Then shop around and compare offers from multiple lenders, banks, credit unions, and online lenders to find the best deal. Once you choose a lender, fill out the application providing information like your income, employment, monthly expenses, and debt. You'll also need to upload documents such as ID, pay stubs, and bank statements. The lender will then review your application and, if approved, will send you a loan offer with terms including the interest rate, loan amount, repayment schedule, and fees. If you accept, the money is typically deposited into your bank account within 1 to 7 business days. From there, you begin making monthly payments until the loan is fully repaid. 10. Smart tips for managing a personal loan responsibly. Getting a personal loan is only half the story. The real challenge is managing it wisely. First and foremost, only borrow what you need and can realistically afford to pay back. Before accepting a loan, carefully review the monthly payment amount and make sure it fits into your budget. Once the loan starts, make your payments on time every month to avoid late fees and protect your credit score. If possible, consider making extra payments toward the principal to pay off the loan faster and save on interest. But check first to ensure there are no prepayment penalties. Also, avoid taking out multiple personal loans at once, as this can lead to a cycle of debt. Finally, keep track of your loan balance and payment history so you always know where you stand. Good management can make a personal loan a helpful tool rather than a financial burden. If you like this video and would like to see more like it, please give it the thumbs up, leave a comment, and click the button to subscribe.